Thank you, Mr. Chairman. Thank you for the hearing. And let me move to a slightly different subject as well. I want to come back to systemic regulator, but I'd like to hear Ms. Bair and Mr. Stern. I think we're all been waiting for some time for the release of the so-called stress test results, and we've heard Treasury say that none of the 19 banks are going to, I guess, quote-unquote, fail. One, I'd like to get your evaluation of have these tests been rigorous enough, number one. Two, what additional steps can you or we take to give confidence to the markets that the analysis has been rigorous enough? And three, what else can we do to encourage these institutions that need additional capital to push and prod them into hopefully finding that in the private sector?
Well, I think, first of all, all these institutions exceed regulatory standards for well capitalized, and the stress test really was to determine what, if we have a more adverse economic scenario over the next couple of years, will they have adequate capital buffers now to withstand a more adverse economic scenario? So in that sense, the stress test is more rigorous than the current regulatory standards for being well capitalized.
Although, again, we're rapidly approaching the outer reaches
well, that's true.
of the downside of the stress.
I think that's right, and I think this is something that needs to continue to be monitored, and we do this all the time, and will continue to do so. But I think even though the unemployment rate may have been a little bit higher, I think some of the assumptions on home price declines were pretty aggressive. So I'm hoping that all nets out, but clearly it needs to continue to be monitored. But I think this will be a confidence-instilling announcement. There will be additional needs for capital buffers for some institutions, but I think there will be mechanisms to do that within the next 6 months. And yes, I would agree, those institutions need to look to non-government sources first. The Treasury can be there as a backstop, but they should look to non-government sources first, and first and foremost to raise new equity if possible, or if they can't do that, or in conjunction with that, to convert some of their other securities in their debt structure, in their equity structure into common stock to increase the tangible common equity ratio, which is very important for market perception right now.
And you're confident that there'll be enough data release that will result in a confidence building rather than confidence weakening?
Well, I hope so. This is an interagency process, and it's a holding company process. It's been led by the Federal Reserve, as it should be. They're the holding company regulator. I think they've done an outstanding job. They have great staff. And so I think that it will be confidence instilling. There are obviously judgment calls that have to be made on all of this. And I'm sure there'll be probably the banks will say we're being too tough, and there'll be analysts that are saying we weren't tough enough. But hopefully we're in the middle there at the right place. But a lot of it's just judgment.
Mr. Stern, do you have a comment?
I think Chairman Bair covered it thoroughly, and I would prefer not, until the results are out, I prefer not to go further.
I'd like to go back in my remaining time. Thank you. To the notion that the chairman raised in terms of systemic risk and the idea of a council, which I think has some attractiveness, but also some challenges. I mean, what guidance, advice would you have if we were to at least continue to pursue the possibilities of this option, of how we would make sure that that information would actually be forced up and truly shared, number one. And two, how would we ensure, and what structural advice could you give us to ensure that this council wouldn't end up becoming simply a debating society? And number three, when this council or group reached some conclusion, how could we ensure that they could act with some force?
Right.
And I'd love your comment on all three.
Well, I think accountability will be key. I think, the statute needs to put accountability for systemic risk with this council. And I think it needs to be given real authority to write rules and to set capital standards and to collect information and make sure it's shared with the other regulators. But I think if you provide that mandate, that accountability, as well as with real legal authority, I think you will get the result that you want. There's nothing perfect about supervision, and this is why we've also suggested a resolution mechanism to enhance market discipline as well as protect taxpayers, and an assessment system that the resolution authority would have as well to provide disincentives for higher risk behavior. But I think those three steps in combination, you would dramatically improve the situation. Again, I think part of the problem is nobody really has a mandate right now. for the entire system. And there were problems, for instance, capital arbitrage between investment banks and commercial banks, different capital standards. That's exactly the type of issue that this type of council could have not only identified, but had a forcing mechanism to resolve, which didn't exist before.
But one of the things we need to do is make sure that information that may
Yes.
currently reside in
Yes.
the day-to-day prudential regulator actually would get
Would
forced
go
up and
up.
actually shared, which seems
That's
in
right.
the
And-
past that some of this information's been out there, but it's not been.
That's exactly right. And the clear authority needs to be able to collect it, to force the sharing of the information. We give the SEC our bank data, they give us their trading data, whatever. And that's just, then you have a mechanism to do that. Right now, sometimes it eventually happens, but it can be a longer process, and it's not a coordinated, systematic process. So I think with the council, with the mandate and the legal authorities to carry out that mandate, I think you would dramatically improve the situation. I do.
Mr. Chairman, I know I've gone beyond my time, but if I could have just Mr. Stern answer the question too, sir.
Yes, well, I think two things are going to be very important in that regard. One is authority to act, and I would add that working with the supervisors is very important because they have a lot of on-the-ground information that would be valuable in this process. But I also would think that for systemic supervision to be effective, this group, whether it's an institution or whether it's a council or whatever it is, would have to have the ability, under the right circumstances, to intervene if they thought that the consolidated supervisor, whether it was a bank supervisor or an insurance company supervisor or whatever, wasn't doing an adequate, sufficient job. So if in their judgment, the job that was being done by the principal supervisor just wasn't adequate, they could step in and ask for more forceful action. And I think that would be important.
Thank you, Mr. Chairman.